The great change of the shale revolution is not just reestablishing U.S. as a global energy gigapower. It's the coupling of oil and gas production on a massive scale, which makes those two commodities, classic co-production economics. And holds out the potential to put a big enough bid under natural gas, that plus the historic, unbelievable wave of LNG export facilities coming online along the U.S. Gulf Coast and in Mexico. There's a world where the cleanest burning hydrocarbon on the board, natural gas, is not any longer the cheapest. And the consequences of that world are pretty profound.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. In today's discussion, we look at the all-important energy market. Remember, without energy, there's no economy. As we look to the future, where are global energy trends headed? How is the AI race and its voracious need for cheap electrons changing the game? And where are the best opportunities for investors likely to lie? To discuss in depth, we're fortunate to sit down again with the green chicken himself, the energy expert, Doomberg. Doomberg, it's wonderful to see you again. Thanks so much for joining us today.
Adam, my friend, great to be back with you. It's been too long.
It has been too long, and we will remedy that more in 2026. But as long as it's been, I get the sense that things are going no less amazingly for you and the Doomberg team. Kudos to you guys for not only continuing to put out such a consistently great product, but just for the success in the business metrics. I follow your number of subscribers on the Substack Top 100. You guys remain one of the top financial Substacks in the entire world.
Yeah, no, it's been great. It's unbelievable. It's thrilling. It's humbling. It's bizarre. It's not what I ever imagined I'd be doing, but we couldn't be more grateful to our subscribers, especially the paying ones, although all subscribers are precious, of course, and to people like you for giving us a platform to grow our business.
Well, it is a privilege to be able to do so. And I got to say, I as you know, couple companies ago, I worked for a company that wrote a lot about the global energy situation, and there were times where there were debates in the company about whether to write about more about energy or less about energy, and sort of the internal perspective was, no, just nobody really wants to hear it, right? It's important to talk about, but they just don't do as well as the pieces around economics. And it's really hard to make a business, especially a newsletter business, talking about energy. You guys have completely destroyed that myth.
Oh, no, I appreciate it. It's been a great journey. And, we did come of age during the European energy crisis, of course, and that was good timing, I suppose, from the raw growth prospects perspective. But at the same time, we pour so much into the quality of the work, live and die by every typo, as you can imagine, rare as they have become. And that attention to detail, mixing a bit of humor. And I think we've had a pretty good track record of success when it comes to using our knowledge and internal expertise about energy to make some pretty far out there predictions that came to pass. Not all of them, of course, nobody bats 1,000, but we have a pretty good hit rate, and pretty proud of our work. And most importantly, of course, we're not afraid to be wrong. And when we're wrong, we admit it, and then we write about why we were wrong and what we learned from it. And last point I'll say is we've grown to such a scale, over 300,000 subscribers, that it's kind of got like a network effect going. We have inbound suggestions for articles, and we have outbound sources of expertise to bounce things off of on virtually any topic. And since we come from industry and we speak industry's language, we have scores and scores of industry executives who talk to us off the record, but could never say the things that we write in public. And so that's a pretty unique advantage for us. And so it's been a great ride, an absolutely great ride. And same with Thoughtful Money. I remember when you put your own flag out, and to watch you grow as fast and as consequentially as you have has been pretty amazing.
Well, that is very kind. And it's been a great ride for Doomberg, been a great ride for both our companies so far. And hopefully this comment applies to both of ours as well, but particularly for Doomberg, it's been a great ride so far, but I get the sense you're still in very early innings.
Well, let's hope so. From your lips to my bank account.
All right. All right. Well, enough of the Mutual Appreciation Society for now. Let's dive in. I'm almost wondering where to start. Um, yeah, the world continues to consume more fossil fuel than ever. The new administration, meanwhile, is working really hard to roll back the investments being made in the Green New Deal. Nuclear energy continues to be a darling energy source. Um, a little nonplussed on where to dive in, but so maybe I should just ask a general question. What are currently the most significant energy trends that you're watching as we look to enter into the new year of 2026?
Yeah, it's a great question. The big one on the board, of course, is AI-driven demand for natural gas globally. Natural gas is the bridging fuel for AI needs, and this is triggering a boom in drilling in the U.S. in particular. The U.S. continues to just be awash in natural gas. And there's long-term consequences for this, which we think are actually pretty bearish for oil, which we can talk about. Obviously, the geopolitical tensions are top of mind. The bifurcation of the world between the Western-led G7 type financial bloc and the BRICS countries led by Russia and China, and India and Brazil to a sort of lesser extent, but still very important ones. And then the refocus towards the Western Hemisphere, where we have argued that there's probably 10 million incremental barrels of oil per day waiting to be developed if those resources were in the types of hands that could marshal the capital and infrastructure needed to do that. Happy to walk through that calculation as well. But the big driver, AI, natural gas, second and third order market effects from that, geopolitical tensions or lack thereof, and the ongoing Monroe Doctrine under the Trump administration focusing on the Western Hemisphere.
All right. Do you mind if we just sort of peel each of those layers off the onion?
Sure, go for it. So where would you like me to start?
Well, why don't we just start on the first one, the AI demand?
Yeah, there's obviously we've had a bit of back and forth with our mutual friends over at GNR and a few others about the prospect of U.S. shale gas turning over, and we just wholeheartedly reject that view. Obviously, we think peak cheap oil is a myth. Peak cheap gas is an even bigger myth. There's just effectively an infinite supply of natural gas in the U.S. This is how we model it. People don't like it when we use that phrase, but as lateral thinkers, we spend a lot of time thinking about infinity and zero as philosophical constructs. They can teach you a lot. Great inputs into your mental model. There's so much gas in the U.S. that if the U.S. decided to put a $5 per million BTU permanent bid under natural gas, production would explode from current levels. There's just so much of it, especially in the Permian Basin. Permian Basin's 0 to 20 BCF per day without even trying. It's a nuisance byproduct today that can't be given away in the spot markets, negative prices today. And yet it's still growing leaps and bounds. In a world where AI demand materializes and a glut of gas turbines eventually arrives and solid oxide fuel cells from companies like Bloom Energy are made at scale, and natural gas demand does tick up to the point where all these data centers go up in the Permian Basin and the midstream players build out enough pipelines to make maximum use of all the wellheads. In a world where natural gas becomes expensive again, $5, $6, $7 a million BTU in the Permian Basin, don't forget it's co-produced with oil. And so in a world today where natural gas is the throwaway byproduct, that could flip. And tomorrow, or some point in the near future, natural gas becomes the prize commodity, and any oil produced in the shale regions where co-production occurs is given away. That could be a real headwind for the price of oil. Having competed, this is where industrial experience is relevant. In certain parts of the commodity world, products are co-produced. And there's nothing worse than owning a pure play factory and competing against a co-producer because dynamics in the second market can spill into yours.
Right.
And so this is what we're seeing, like the great change of the shale revolution. It's not just reestablishing U.S. as a global energy gigapower. It's the coupling of oil and gas production on a massive scale, which makes those two commodities, classic co-production economics. And AI holds out the potential to put a big enough bid under natural gas, that plus the historic, unbelievable wave of LNG export facilities coming online along the U.S. Gulf Coast and in Mexico. Um, there's a world where the cleanest burning hydrocarbon on the board, natural gas, is not any longer the cheapest. And the consequences of that world are pretty profound.
Okay. And natural gas is currently trading at what? Somewhere in the twos?
Depends where. Henry Hub is 4 and change because it looks like it's going to be a cold winter. At least that's what the weather models are spinning out. So $4 a million BTU Henry Hub. The 12-month strip price, which is kind of more stable than spot prices, in the Permian Basin is like, I think the basis is -2, so it's $2 cheaper. And it was -2 in Alberta, British Columbia last time I checked. Now, $4 a million BTU is $25 a barrel oil, $20 a barrel oil in that range. 2 is obviously 12. It's a very cheap hydrocarbon and clean, right? You use it in your home, you burn it on your stovetop, and you don't really have special ventilation when you do. It's a super clean burning fuel. And so, again, the co-production part of it is a massive change. So when people ask, what is the break-even production price? Sorry, what is the break-even price of oil for production in a Permian Basin, let's say? Our answer is it depends on the price of natural gas.
Yeah.
Right? Because you're producing both, and you got to sell both. Producers aren't owners, they're price takers. And so that's the big sea change. And AI could really flip the oil markets on its head.
That's really super interesting. So, okay, in terms of sort of future incremental material sources of demand for natural gas, we have the AI data centers. And real quick, let me just pull up this chart, which I'm sure you've seen before, which is a chart of electricity generation capacity,
Yeah.
China versus Europe and the US and whatnot. And for those that are listening on the podcast and not seeing the visual, Europe and the United States are relatively flat. I mean, this is going back to 1985. I mean, the United States has some growth here, but they're relatively flat, especially in recent decades. Meanwhile, China it's almost a vertical line, and it now dwarfs the electricity generation capacity of Europe and the United States. So, I think from what I can tell, the Trump administration has seen this. They've gotten the message, hey, if we want to win in AI, that race is going to be largely determined by who's got not just the best software, but who's got the best source of supply of cheap, dependable electrons. And China seems to have all the momentum there right now. So apparently we're going to be playing catch up like nobody's business over the next decade plus, trying to meet, maybe even exceed China eventually. Is that indeed kind of the big driver here of natural gas demand from the AI world?
Yeah. So, I mean, it's a fascinating chart. It's a stunning chart. By the way, we look at that chart and we see that China doesn't care about global warming or climate change because 55% of that electricity is produced by
Dirty.
coal today.
Yeah.
Coal is like $5 a million BTU today. So, and dirtier. So the cost to use coal without damaging your environment is much higher than natural gas. And so the US advantage in natural gas is profound. And this is, this chart also, because the US hasn't really expanded grid production that much, we believe that this is going to drive, off-grid AI data centers, where the electricity is made on demand just for the data center. Maybe it's connected to the grid for backup, or feeds a little excess electricity production into the grid. But by and large, the bottleneck that is US grid expansion will be swept aside by made to order custom power plants for data centers specifically.
Okay, but will we be doing both at scale and fast?
Oh yeah, oh yeah,
Yeah.
yeah, yeah. This is there's lots of talk about an AI bubble, and there's unquestionably massive valuation bubbles in the public and the private markets. We're seeing it in the private markets. I'm personally early stage investor in an exciting AI startup. So I see it. I see the valuations. I see how relatively easy it is to raise money. And yet, um, the dot-com bubble burst and the internet was still an amazing thing that totally reshaped society. Or to bring it back to energy directly, sure, shale gas was a bubble. Shale oil and shale gas, the development of U.S. shale was a bubble in the 2010s, and much equity was wiped out. But what was left behind is just amazing infrastructure, amazing technology, amazing resource, reshaping geopolitics historically, on a historic scale. And this is our sort of balanced view of AI. It is a unbelievably game-changing technology. It scares me, actually, what I see, how quickly it's evolving. One of the challenges with investing in the private markets is just how quickly what you think your moat is could be obsolete. So there will be massive amounts of equity wiped out for sure. But yet what remains is a megatrend of epic proportions. One of our operating mental models is that the human endeavor is infinite compute. And if you just have that as an operating mental model, it explains a lot and predicts a lot quite effectively. And we see this massive demand on, it is in a way a bubble on a scale that is unimaginable, but all sort of exponential functions eventually behave that way. It's called the knee of the exponential, or as we call it internally, the Kurzweilian inflection point. When doubling times are shrinking, they'll eventually become a day. In other words, it'll double every day. And we're seeing this just massive build out of computing, infrastructure, technology, advances, and so on. It truly is mind-boggling. That's not to say that this is different this time. The famous, it's the same as all the other bubbles, including what's left when the bubble bursts.
Wow. Okay. So tremendous opportunity. I mean, for humanity in society, but obviously going to place a tremendous amount of demand on for electron production. Natural gas is going to be a key part of that. Like if we have today's demand for natural gas as a baseline, how material is the oncoming demand over, say, the next 5 years? Is it 20% of what we're using right now? Is it twice? Like, what's the order of magnitude you peg it at here?
Yeah, I mean, it could be huge. I mean, we run models internally where we could see demand doubling in 10 years.
Okay,
Um,
that's pretty darn
and
big.
Now there's lots of constraints to that, but markets tend to work their magic when, again, you have the cleanest burning hydrocarbon on the board also being in infinite supply and the cheapest one.
Right,
How often does that happen, right?
right.
Not very. So it's going to be amazing to watch for sure.
Okay, so that's just AI, and this will also be AI related. But we've had the Trump administration going around the world, since Trump shook up the trade board and said, "Look, I want to negotiate better deals for America." And as I understand it, a pretty big element of those deals is, hey, we want to ship you cheap, clean natural gas, and we don't want you buying energy from some other places we don't like Russia and whatnot. And we know that Europe, has been super dependent upon natural gas from Russia. How big of a game changer is natural gas as a sort of a geopolitical trade tool here, and how much incremental demand is that going to bring for U.S. natural gas from these new deals being struck with other countries?
Yeah, I mean, the projections are pretty substantial. So, by the way, like exported natural gas via LNG is not cheap. It trades in lockstep with Brent crude today, which is one of the chart pairs that we watch very closely here. Basically, if you take landed LNG in Europe and multiply it by 6, you get roughly the price of Brent crude, which is no
Okay.
accident. And when that chart deviates, something weird is amiss, which is why we like to watch it. It usually foretells geopolitical risk. But the U.S., let's just put some numbers. The U.S. averaged about 100 BCF per day production in 24 of natural gas. According to the Statistical Review of World Energy, it's currently producing at about 107. I want to say the LNG export capacity is around 13 BCF per day in the US, but projections peg it as high as 30 BCF in the next decade or less. So the US DOE is projecting a doubling of US LNG export capacity in a very short period of time. If the projects that have already reached FID get built on the time frame that is envisioned, we're going to see a massive wave of new LNG export capacity coming online in the US. There's undoubtedly going to be a glut of LNG as other major projects come online as well. And in the long run, natural gas will trade for a narrow band, roughly the same price all over the world, corrected for logistics. And as the US builds out its national natural gas pipeline network, we'll see these basis trades go to zero. All basis trades go to zero eventually. Not quite zero, but arbitrages close. And so those are sort of the big mega trends of physics that you can bet on as an investor, in our view. Now, the LNG trade, Trump is using that to sort of really destroy the European economy. Whether he's doing it on purpose or not is an interesting question. But Europe just can't compete. So in this world, because Europe doesn't produce its own hydrocarbons, it's really the big loser in all geopolitical scenarios. They are being hooked on expensive LNG. The rest of the world, the rest of the big manufacturing societies, usually have access to natural gas via land pipeline. LNG is a luxury in a way, or a necessity, where you don't really have other choices, like Japan, for example. And Japan has cured its LNG exposure by basically owning every aspect of the LNG supply chain that it can. It's always investing in these companies, and therefore the profits sort of come home. Europe's not doing the same thing, at least not on that scale. And so Europe is cutting itself off from cheap Russian energy and hooking itself onto expensive Qatari and US energy. And its heavy industry is suffering as a consequence.
Okay, and so on the so generally from the Russia pipelines, Europe was getting gas, right?
Yeah.
Gaseous natural gas. And just to let folks know, so when Doomberg says LNG, he means liquefied natural gas. And we do is we compress it to turn it into a liquid that makes it much easier to ship across oceans and things like that. But it's more expensive because you have to expend energy to liquefy the natural gas. So Doomberg, roughly, what's the price delta between the cheap gaseous Russian gas and US's liquefied natural gas?
Well, I mean, today, if natural gas at Henry Hub is $4 a million BTU, landed LNG in Europe is 11.
Okay.
So that's, almost triple the price. And pipeline from Russia, I don't know the numbers because these were mostly private contracts, but I hear it was around 550, 6 in that range.
Okay, so it's about a doubling for them.
It's about a doubling for them, but on a sustained basis, and oftentimes goes much higher. So, LNG prices are much more volatile than pipeline. Pipeline contracts are typically signed for many years, decades. These pipelines tend to be immortal unless they're, destroyed. And just to give you a benchmark, before
Yeah, unless they're blown up, right?
yeah, unless the crew of Gilligan's Island gets on its boat and blows up Nord Stream 2, yeah. Before Nord Stream 2 was completed, rough math, Europe was getting about 15 BCF per day from Russia via pipelines. And if they're going to cut themselves off completely from that, and you look at how much excess LNG the US and Qatar are bringing on, you could see where that trade is being made. Russia is redirecting some of that gas to China and using more of it internally to, don't forget, I mean, people think that, oh, let's cut off Russian gas or Russian crude or Russian diesel. All that does is make Russia stop exporting. It still has a huge amount of excess capacity for its internal markets. And so if we make, Russia stop selling natural gas to Europe through sanctions and other activities, it just makes natural gas that much cheaper for the Russian military industrial complex. And last I checked, you need hydrocarbons to make bombs.
Yeah. Yeah. Okay. So, I'm just trying to think here. So in the next 5, 10 years, as the U.S. goes hog wild in exporting natural gas, do you expect prices to come down at all during this, kind of at least near-term
Yeah.
natural gas glut that you expect, or is 11 kind of the best Europe can hope for?
I mean, there comes a point where, our equilibrium price for oil is $55 a barrel because in our view, $10 per million BTU landed LNG, 5.6 times that number, 6 times that number gets you crude, um, is the price where everybody can earn their cost of capital. Um, Especially since drilling in the US has become so cheap. The break-even price for pure gas drillers, again, back to the whole associated production dilemma, in Appalachia, for example, Marcellus Shale and so on, the break-even price is like $2 a million BTU and change. It's pretty incredible. It's like Saudi Arabia price of oil for U.S. natural gas producers, right? Like the cost
Hmm.
to produce. And so by the time you get it to your liquefaction plant, you freeze it and then you pressurize it and you put it on a boat and then that boat sails across the ocean and it gets to a regasification facility and the midstream player that operates the pipeline from the regasification facility to your power plant catches their vig and when you add it all up, $10 a million BTU, starting with a $2 per million BTU and change production cost in the US is roughly the price at which everybody makes money. If there's a glut of LNG, then you would expect that that could close. And in the commodity world, everybody knows that sometimes commodity players lose a lot of money. There's an enormous amount of LNG export capacity going up. This is driven by the fact that the US and Qatar is sitting on the largest natural gas reserves in the world. Um, it's so cheap to produce it. And so if they could, take something that costs $1 and flip it for $4, you, it makes good money. And who cares if it's 350?
Okay. All right. So anyways, uh, Europe not going to get out of that bind anytime soon. Obviously, they are weaning themselves off of the Russian gas because of, you know, national security issues, continental security issues. And the U.S. is making, a big investment to say, hey, we're gonna be your supplier along with the Qataris there. What would be the impact of peace in Ukraine? Will Russia ever get back in the good graces of Europe enough for them to relight up these pipelines, or are these pipelines just going to rust in the ground there, do you think?
Let me invert your question. Will Russia ever do Europe the favor of selling it cheap natural gas ever again? I
Okay.
mean, there's this false narrative that somehow Russia benefited more than Europe from these gas sales. Without energy, there is no economy. You said it yourself.
Yeah.
Okay, you don't want energy, and now we have an abundance of it. Fine. I mean, who loses in that trade? You have to think about, possession is 90% of the law, right? I would much rather be a country in possession of enormous natural gas reserves and producing more than our domestic economy needs than
Hmm.
to be a country that has wired its entire economy around a continuing access to that cheap commodity and having it suddenly turned off.
Yeah. So I understand that Europe's in a real bind here, but again, we're making kind of, you know, big plans to be shipping all this liquefied natural gas to Europe. Is there a material chance that if there's peace in Ukraine in a year or two, that Europe might go back and say, you know what, US, forget it. We don't need your liquefied natural
Uh,
gas because we can get the cheap stuff directly from Russia.
no, I just don't see it. Look, the current leadership of both Europe and Russia have basically parted ways.
Yeah.
And I don't see it. In fact, the bigger risk to Europe, which nobody talks about, the potential glut and LNG notwithstanding. If demand for natural gas in the US spikes because of AI and the US gets a cold winter, don't think for a second that Trump isn't going to turn off LNG exports, keep the gas home. I
Hmm.
mean, there's a world where, further punishing Europe indirectly for, like, let's put it this way. If natural gas spiked to $10 a million BTU tomorrow, Trump would halt LNG exports in a heartbeat.
Okay.
Of course he would. But that's the analogy that explains Russia's relative advantage over Europe. Essentially, that's the same scenario. Russia is no longer exporting mountains of natural gas to Europe, so it has an even bigger mountain of natural gas to gorge upon in its domestic economy, and then so that's what would happen in the U.S. if prices got too high.
Okay. Well, look, if I took my notes correctly, and correct me if I didn't, you said that the AI-driven demand for natural gas could potentially double the demand for natural gas, today's demand, within about 10 years or so. If I heard you right, I think you said with these new deals that we're striking, they could also potentially double. Um, is there a potential for the AI domestic demand to get so great that it actually would force us to constrain what we then
Yeah,
export?
that's the point a point I exactly made. And the second doubling is just the doubling of LNG exports, not the doubling of total production. And the only thing I would
Oh,
add,
okay.
yeah, the only thing I would add to your comment is when I say the U.S., I kind of envision Alberta and British Columbia being part of that. They have an enormous amount of natural gas up there. They're building their own LNG export capacity. There is pipeline infrastructure to the U.S. Um, you could think of Alberta, British Columbia as a mini Permian Basin, so to speak, when it comes to gas growth. Really exploded there too. Now, is a doubling of U.S. natural gas production our base case? No, it is not. But it is in the Monte Carlo simulation of possibilities. It's on the board.
Okay. All right. Um, all right. Well, look, is there anything on the geopolitical side that we haven't talked about um, that's not related to the Western Hemisphere Monroe Doctrine, point number
Sure.
three you mentioned earlier, that's important to get on the board here?
I just think the ever closing relationship between Russia and China, the Power of Siberia 2 pipeline has been approved, which is a new development since you and I last spoke. That routes about a third of what used to go to Europe directly to China. That, of course, will impact the LNG markets because China, which is a major importer of LNG, will no longer need to do so at the scale that it has done
Hmm.
historically. That's a pretty important project. We'll see how quickly that gets built. There's still significant pipelines from Russia to Turkey that feed Europe. Whether those become the target of sabotage operations is a risk on the board for sure. Turkstream and Bluestream, I believe, are the two major pipelines. So those are sort of the hot spots that we're watching. But overall, I think we've covered it pretty comprehensively.
Okay. All right. Um, Let me just ask you this real quick before we move to the South America part of it. Um, when you look at the board and you said, "Hey, I much would rather prefer to be a country sitting on, vast amounts of plentiful, cheap natural gas," um, who is best positioned right now, energy-wise, in your point of view, at least in terms of the major powers?
Sure. Well, obviously, the U.S. and Russia are very well positioned. China's pretty well positioned because of its reliance on coal. It produces an enormous amount of coal. It burns 55% of all the world's coal. It's actually using an enormous amount of coal to make oil products, coal to chemicals. I think Javier Blas was out with an interesting article on Bloomberg saying that if China's coal to chemicals industry were a country, it'd be the second biggest coal consuming country in the world. They just do things on scales that you just can't imagine.
Can't imagine. Yeah.
Yeah, but like there's some smaller players that are very well positioned as well. We call them, countries that punch above their weight geopolitically. Um, Obviously, we mentioned Qatar,
Yeah.
but Malaysia, another country, is sneaky, sneaky strong. We noted with interest when Oracle decided to cut a deal with Malaysia. So all of these LNG exporters are great places to build data centers, and you just skip the whole, liquefaction, regasification cycle and just put them at the source. So why build an LNG export terminal when you can just build a data center right there? And so we're seeing that in the Middle East.
I was going to say we're seeing that that's a big part of the Middle East plan, right?
Yeah, United Arab Emirates, huge AI center. If we just take a step back, this is often not fully articulated in the sort of traditional energy press. The Middle East punches well below its weight in natural gas than its resource base would imply. Why? Well, for decades, the valuable commodity was oil, and they would just burn the natural gas or flare it or just vent it. It's a nuisance. It takes infrastructure
Right.
to make use of natural gas. Much like in the US, which has the world's largest, most sophisticated, most awesome natural gas engine. We model the US natural gas infrastructure as one sort of beating engine. Um, with each investment, the Middle East is becoming more and more and more of a gas player. And Saudi Arabia, for example, burns, I don't know, 600,000 barrels a day, I think I saw, of oil to produce electricity when it's sitting on a mountain of natural gas. That's all gonna get turned off, right? And
Yeah. Yeah.
switched. And so you're going to see as isolated data centers um, go to where the molecules are. And it's a lot cheaper to send data around the world than it is to send natural gas, right? Now,
Absolutely.
the Middle East has a challenge. It's hot, right? And half of the energy used in a data center is for cooling. And that makes places like Canada and Russia, Siberia, excellent places for data centers. Russia is soon to punch above its weight, or at least what Western analysts give it credit for being able to do in the AI data center world. But so too, British Columbia, Alberta is an attractive place. Weather does matter. But countries like Malaysia, even Trinidad and Tobago, an early LNG exporter. We saw Exxon now is investing in exploration because they're right next door in Guyana. And we note with a smirk that the U.S. military armada is using Trinidad and Tobago basically as a stationary, military base right off of Venezuela's coast. And I'm
Mhm.
jumping ahead to the Monroe Doctrine section of our talk, but there's lots of. If you just go to the Statistical Review of World Energy and download their handy spreadsheet that they give out every June, which is a core input into our work, and click over to LNG exporter tab and sort the countries by volume, you'll see a handy guide to where AI data centers are likely to start popping up.
Okay, that's actually it's a really great methodology to use to figure out that question. All right, so real quick before we get to the third point, you were on this channel I think over a year ago now, and had a really fascinating debate with Adam Rosenzweig about peak oil, or at least cheap peak oil, or peak cheap oil. I'm sorry. And two questions for you. One, I'd love to just very quickly get from you an update as to how well you feel your argument has aged since then. With oil trading, 60 and below recently, I think probably pretty well. And also from that discussion and some other ones that we've had on this channel, Doomberg, you've talked a lot about the fact that uh, when we're drilling for oil and gas, we get a lot of other hydrocarbons out of that process that increasingly can be used for key uses like transport, or can be converted into other forms of liquid hydrocarbons to be used for those purposes. Um, how how has that developed since you
Sure.
and I last talked on that? Is that trend continuing?
Yeah, of course, this is the forever trend. I think our debate was actually in January of 24, almost 2 years ago.
Wow, almost 2 years ago now.
Yeah, and obviously, we believed everything we said then, and we haven't changed our views. And it's not like we're blind to the evidence. We see the evidence pouring in. I think the market is not pricing in that we are anywhere close to running out of oil, as will become clear when we talk about the Doctrine, I guess they're calling it, in the Western Hemisphere. As you mentioned, oil is much cheaper than it was. The world is consuming more of it. And the chart that we used back then, I wish I had it, is the number of barrels of oil um, an ounce of gold buys you, or maybe the chart I used was the fraction of an ounce of a gold that you would need to buy a barrel of oil. They're both the
Hmm.
same chart, they're just different directions. That number has skyrocketed, of course, because gold is appreciated. But if you think gold is sort of fixed, and the other prices of the world revolve around it, as we do to a degree, you can buy, well, an enormous bounty of oil for an ounce of gold, far higher than it was when we had that debate, for example.
Yes.
And it's just, I don't know, I just don't see it, right? I mean, it's so counter to everything our industry sources tell us, that it's hard to articulate. Now, there's always a risk, and one of the big risks of an analyst is that you give higher priority to private data than you should. It's a risk we're aware of, but in this case, we don't think we're susceptible to that risk, because so many people are saying it so consistently from positions where they would have every reason to say the opposite story. Oil companies don't like the fact that there's an infinite supply of oil. They would like for the world to believe that this is scarce and that we're about to run out of it. And yet, to a person, we're just drowning in this stuff. Again, if there were evidence in the markets anywhere that would point to it, we would certainly be open to changing our minds. But there's just so much of it, Adam. And again, long before geology becomes a constraint, politics is a constraining factor everywhere. If oil went to $300 a barrel today, the political obstacles to production growth would be wiped away, and we'd be right back to $50, $60 a barrel.
Yeah, I've mentioned your comment that a political constraint can be removed vastly easier than a geological constraint. I've quoted that many times over the past years.
Well, just look at Venezuela, which we'll talk about. I mean, that used to produce 4, now produces 1 million barrel a day, and there's nothing about the geology that caused that.
All right, well, let's head down to that topic in just a second, but to the second part of my question about the ability to convert other different types of hydrocarbons to ones that can be used just like, the gasoline we put in our car. What's happening there?
Sure, and this reps back into Europe. So just as an example, there's many such examples, but what we're talking about really is natural gas liquids, that array of light hydrocarbons that isn't natural gas, but isn't quite oil in traditional sense. One of the things you can do with it is turn it into chemicals. All across Europe, there are these facilities known as crackers, and they make the core chemicals that make plastics and milk jugs and garbage bags and tarps and all the various things that make society work
that are petroleum derived.
Yeah. They have been historically mostly been fed with an oil product, naphtha, oily product, comes from a barrel of oil, and they would crack it and they would make ethylene and propylene and a gamish of other things. And what we're seeing instead is, ethylene on purpose crackers. These are fed using ethane, which is the most bountiful of the natural gas liquids, even though it is itself a gas. It's the C2 molecule from an oily mixture in a shale patch, for example. And we're seeing a rise of these giant ethane-only crackers and a wave of naphtha crackers shutting down. Well, the naphtha that fed those crackers has other uses and would go and compete against the other parts of a barrel of oil. And that sort of creates a supply glut of part of a barrel of oil that refiners have to get rid of, and an outlet for NGL production, say, in the U.S. And in fact, one of the largest exports from the U.S. to China that's been caught up in all this tariff wars is ethane and LPG, all of these light hydrocarbons that China has overbuilt really these chemical factories to convert that fuel into useful products. And so we see this everywhere we look. We did a whole presentation on this for our Doom Zoom, our Pro tier. We did a couple of these. The amount of NGLs in the major storage facilities in the US is becoming close to on par with how much crude oil is in the Strategic Petroleum Reserve.
Wow.
Yeah. It's actually pretty, and all this is sort of built under the radar, right? I mean, obviously people in the industry know it and they see it. But it is truly staggering, like 350 million barrels in storage. I'm just pulling up the Doom Zoom presentation to get you the numbers as they were in February. The presentation was called Trend Lightly, Natural Gas Liquids and the Future of Hydrocarbons. Not that I fed you this as a topic. And so like, it's just so much of it and it's so cheap. as a general rule, as a rule of thumb, um, gas is cheap. Natural gas liquids is slightly more expensive, but still cheaper than crude oil, and then crude oil is more expensive. So there's this huge hub in Mont, Belvieu, Texas, and at the time of that presentation, it had 250 million barrels of storage. And it oscillates as high as 300 million barrels in early 2020, of course, because of COVID. There's just a huge amount of these are in salt domes, right? And they pump them down in these salt domes, and they have the C1s, so the C2s, the C3s, C4, C5, and they right there positioned for export. Houston Channel. It's just an enormous facility. There's another one in Kansas, I believe, not quite on that scale. But like when you hear Mont Belvieu NGL pricing, that's like the Henry Hub of natural gas kind of a benchmark.
Okay, so am I correct in just taking this as this will be the sort of another headwind against the price of oil appreciating too much for too long, because this is increasingly bringing on a kind of an alternative supply of things that can be used that oil would otherwise be used for?
Yeah, OPEC has done this to itself, of course, because as we said earlier, the Middle East is not really a major natural gas producer, and by extension, not really a major NGL producer. They have worked to keep the price of crude oil artificially high. It's a cartel. Oil is a managed market. And in so doing, they have inspired this competition from below, who are co-producing expensive oil and all of this cheap stuff. And guess what? Energy arbitrages always close. And so this tsunami of cheap stuff that the shale revolution has uncorked is going to undercut OPEC. There is a molecular semantic shift going on in the very definition of what oil is, which is what I was trying to argue during the debate and what you and I have talked about before, but it's worth reminding people. The engines that we have in society today are tuned to burn the hydrocarbons that were available when they became standard. Those standards can shift, especially if the price of the fuel is very cheap. So yes, diesel is great for long haul trucking and delivery trucking, but natural gas is better if you're China because it burns so much cleaner and you worry about pollution in the cities. And if it's going to be cheaper and comes with less pollution issues, guess what? We'll switch the engines. And so as the infrastructure gets built out and as the engines get switched, all of these hydrocarbons will sell for the same price on an energy content basis, corrected for logistics.
Okay, so makes sense. Made sense to me when you made it the first time I heard it, but it sounds like you're just saying, yep, time is proving out that this is indeed the way things are going.
Correct.
All right, so last but not least, let's get to the Western Hemisphere, where essentially we've mentioned the term Monroe Doctrine, but certainly seems the new administration is saying that sounds, we think that old idea is a good one, and we want to update it for the new millennium. And let's make sure that we make the most of the geographic region that we have the most control, influence over. And for the most part, they're almost all allies with a few exceptions.
A couple of big ones.
Yeah.
But, on Trump's inauguration day, January 20th, we wrote a piece called Misreading the Room. And I believe the social preview for it was something along the lines of, if Greenland was the appetizer, might Venezuela be the main course? And that was quite easy to see. It never ceases to amaze us how few geopolitical analysts start their analysis with energy. Because if you do it, it just explains so much. It doesn't explain everything, but it does explain a whole lot of the variance. Look,
sorry to interrupt, but there's that old saying that, in the end, when it really comes down to it, all wars are resource wars.
Yeah, 100%.
Almost all resource wars are kind of about energy.
Correct,
So
right? Or derivatives of it, like food or fresh water, which is nothing more than an embodiment of energy. So, look, I said at the top of the show, in the right hands with the right resources, there's 10 million barrels per day of incremental oil production waiting to be developed in the South America.
And is that like the easy stuff, or is that the whole pie?
No, just let me walk you through the numbers, all right?
Yeah.
So, Mexico south, right? In the Western Hemisphere, south of the US. Mexico used to produce 4. It produces two now, riddled with corruption and narco gang influence. Venezuela used to produce four, produces one now. Could easily do five. We think Venezuela is like Canada, but with much poorer contract law.
Yep.
So there's five without even trying. You have Guyana going from 0 to 1 on the way to 2. Brazil just smashed through 4 million barrels a day. Tack another one there. And Vaca Muerta is every bit as good as the Permian Basin. The issue with Vaca Muerta is that it's in Argentina, right? And so we followed up the misreading the room piece with a piece we wrote a couple of months ago called Mosaic Theory, where we walked through each of these countries and made some predictions, like, for example, that the U.S. would have to bail out Argentina. And lo and behold, they did. It's not because Melee looks good with the chainsaw and he sweet talks Trump. I mean, it's because Vaca Muerta's there. It's just, if Vaca Muerta wasn't there, Scott Bessent would not be backstopping Malay.
So you're pretty sure when Bessent made the bailout there that part of the terms were we're going to get a pretty sweet deal in accessing?
I mean, we quoted the CEO of Chevron in the piece who stands ready to help Argentina develop its Vaca Muerta resources. I mean, Chevron's knee deep in Venezuela. The super majors have assembled in Guyana. We wrote a piece called Blooming Flower. Once you have enough super majors in one area, they start looking around because they've got this critical mass of midstreamers and supply providers and services providers all there too. And they've reached critical mass. They don't want to leave because they're all there. So you just stick a pin in the map around Guyana and then, tie a string to a pencil and draw a circle around Guyana. Suriname, all of a sudden, Trinidad and Tobago, Venezuela's right there. Venezuela claims Guyana has its own, of course, at least the oil-producing parts of it. So you could see that, as we said in the piece, misreading the room, the history of strongman dictators who get in the way of oil development is not a glorious one.
Mm-hmm.
And we suggested that perhaps Maduro should avoid flying on a private jet anytime soon.
Or walking by any windows?
Or walking by any windows. And look, it's cynical, and we shouldn't be making light of it because actually I think much of it is illegal. But it's reality. Like, you just can't deny the reality. And so as an analyst trying to get something right, not trying to advocate for something, it's quite clear that there's 10 million barrels a day. Look, the Western Hemisphere already outproduces the Middle East in oil and vastly outproduces it in natural gas. There's plenty to do in the Western Hemisphere, in a world of spheres of influence where, Trump cuts a grand bargain with China and Russia. There's huge opportunity for manufacturing revitalization in the U.S. powered by an abundant supply of cheap hydrocarbons.
Okay. So, couple things off of this. Now, obviously, from an American perspective, America would like to get as much of a piece of that action as it could. And I guess first too, just to my earlier question, I think the answer is yes, which is this incremental 10 million barrels a day. It's kind of the easy stuff, right? You're saying, we already get kind of half of the way there just by returning Mexico and Venezuela to kind of where they were previously, right? So this doesn't require us having to go out and tap a whole bunch of offshore oil deposits that have never been tapped yet. It's really just making use of kind of known existing resources, correct?
Yeah, I mean, not to say that that's easy, of course. I mean, these are political quagmires for a reason.
Right, but it's not like you're betting on we think there's a bunch of oil offshore.
No.
Yeah.
Venezuela has the world's largest hydrocarbon resource base, bigger than Saudi Arabia.
Okay, which is amazing.
Yes.
So if you're America and you are looking to really unite the Western Hemisphere, right, under, say, a new Pax Americana, and haven't heard much about it lately, but Trump has talked about the Golden Dome, kind of protecting, hey, you play with us, you get free protection under this defense network that we're building. So, obviously, I guess he'd love to use the carrot as much as possible. Hey, Argentina will bail you out, but then you got to let Chevron come in and help you build out this stuff, right? And a lot of these countries probably are happy to see that. They don't have the technology at scale that the U.S. companies do. Now, obviously, you've got Maduro, a very unfriendly regime to the U.S. In Venezuela. I know you made the joke you did, but Trump has portrayed himself as the peace president, right? And he and his cabinet have said, look, we are putting an end to American adventurism. We're getting out of the business of regime change. Do you think that statement has an asterisk by it, except for Venezuela?
I mean, come on. You know, the peace president renames the Department of Defense the Department of War.
Yep.
Um, and last I checked, Marco Rubio was a charter member of the Uni Party Forever War neocon wing of the Washington, D.C. establishment.
Yeah.
My cynical interpretation is, sure, we're not going to do the Ukraine thing anymore, but when you're in the bomb-making business, peace is a working capital problem, and so let's have this war over here instead. Pick on somebody your own size kind of thing, where a war that Trump can win in theory, and the military-industrial complex doesn't need to panic about peace. There's always a war somewhere. There's always bombs being dropped somewhere, and it's hard not to be cynical. But we can't send more arms to Ukraine, but we're going to go ahead and do Venezuela. Who knows? Maybe it'll happen. Maybe it won't. I'm seeing all kinds of conflicting stories. An interesting story in the Atlantic today, which is not always a bastion of truth, about Maduro offering to leave as long as he's taken care of and he gets to, have a nice condo somewhere on a beach.
Yeah.
Who
But
knows?
let's assume for a moment that happens, right? One way or another, Maduro's gone, but let's assume it's the most bloodless way, right? And he's out. And let's say that woman who, forgetting her name, but the one that just won the Nobel Peace Prize, right?
Yeah.
There's a opponent there from Venezuela. She
Yeah.
gets in, assuming she's more America friendly. Like, what happens if it's like kind of game on for how we want to play the game there? What actually gets unlocked quickly?
I mean, and again, her name escapes me too, but I do find quite humorous that the Nobel Peace Prize Committee selected the regime change candidate in waiting to give this year's award to. Seemed like the fix might have been in the old
Yep.
consolation prize for Trump.
Mhm.
I think what happens is everybody knows where the oil is, and the aging infrastructure gets upgraded, and very generous contracts are signed by the new Venezuelan government with outside oil super majors. The Chinese probably will play a role in it as well. They're pretty big into Guyana. They own, I think, a third of Exxon's joint venture there.
Okay. So sorry to interject. I want you to keep answering, but I think part of Trump's strategy is to get Chinese influence out of the Western Hemisphere. How successful do you think the U.S. be in that?
Exxon and the Chinese have a very good working relationship. What we see, again, one of the comments I was going to say to your question was you have to separate countries from the particular leaders of countries in the moment.
Hmm.
They're often two very different things.
Yep.
China has significant claims in Venezuela, and one of the things that would probably have to happen is a resolution of those claims in an equitable way, probably part of some larger trade negotiation where the details are not released. And so, in the end, business is business. The Chinese are, minority owners in all kinds of American strategic energy projects. Well, energy projects that are strategic to America abroad, let's put it that way. And I don't think that they would be wiped out of Venezuela. There'd be too much friction in doing that. A deal would be cut. There'd be some concession somewhere else, and the party would go on. But you'd see a wave of investment. And in a way, if it's done correctly, in the way that Guyana seems to be doing mostly, it could be quite beneficial to the people of Venezuela, who, Lord knows, have suffered greatly in the last couple of decades through a massive and nasty bout of hyperinflation, for one thing. They might have to peg their currency, to the dollar.
To the dollar, sure.
Yeah. This is all sort of known. It's kind of what Guyana is doing, and so there's that. And so yeah, it would just be a wave of concessions and investments, and they would pretend to have an auction for various blocks, and certainly the threat to Guyana would go away, which kind of a catalyst for all this, I think. But who knows? Yeah, it would be a bonanza of investment on par with a big shale patch in the U.S.
Okay. So in the Doomberg base case outlook, how bullish are you on the opportunity here in the Western Southern Hemisphere getting unlocked?
I mean, I think quite bullish on the resources getting developed faster than people anticipate on a scale that few are measuring today. That's bearish for oil prices. It's
Hmm.
bullish. It is bullish for any company that makes money on volume, not price. Um, and so we would see, I think be particularly good for, the rig providers and the services providers and the
These
engineering
midstream
firms and
operators we hear
yeah,
about.
midstream, royalty plays and things like that. You know, it, it would be bullish for construction. And when construction is booming, you don't necessarily want to own the buildings.
Okay. So you want to kind of find the Nvidia of this space, right? That's just
Yeah,
all the CapEx is flowing into it.
yeah, that's a whole other can of worms. But
Yeah.
yeah, no, you want to find the picks and shovels. That this is the sort of classic, cliche almost business school case study, right? Gold miners don't make money. People who sell shovels to gold miners do.
Yeah. Okay. All right. Well, look, I'm looking at the time, Doomberg. I have to start wrapping it up, but this, as usual, has just been a fascinating discussion. Thank you so much for sharing your expertise with us. Just to get down to where the rubber meets the road, I'm going to ask you, because this is an investing platform, what specific investment opportunities in the energy space have your attention at the most right now? I know it's in the past, it's been either kind of these midstream players, or it's been those who can make an arbitrage
Hmm.
off of getting access to things like cheap natural gas, and then using that to create a more higher value product that can sell at a greater profit on the global market. Have your views changed? What's got your attention most right now?
Yeah, I'm still very bullish on the prospects for, midstream operators. Anybody who is enabling the data center constructions to go faster. You saw, Bloom Energy stock just skyrocket because its solution seems to be validated. Not a recommendation to get long a stock that's already had an Icarus print like this, but that's just an example of things you should be looking for. Beyond energy, but to the derivatives of energy, anything that China supplies to the U.S. military industrial complex today is going to see a wave of investment. These Trump deals, which we didn't talk about, but we're publishing on tomorrow, um, is at risk because of the tariff case at the U.S. Supreme Court. But hundreds of billions of dollars were going to be flowing into the U.S. in order to close those gaps. In the private markets, we're just seeing a bonanza of opportunities in this space. Enormous sums of money being invested always means that there's going to be some winners and some big losers. And so
Yeah.
trying to separate those two is an interesting challenge. So, but mostly unchanged. I mean, not much has happened in the energy market since that infamous debate that we had. Oil prices keep going down, and demand for gas continues to creep up, and production is there to meet it.
Okay. And I've been mentioning, just to be transparent on this channel, that oil, world still runs on it. Demand for it keeps going up year after year. Oil, the oil sector, from a stock perspective, has really been one of the more underperforming sectors for a good while now. And it tends to be a boom bust industry. If we're in the bust, will we go back into a boom? I know in the long term, you think oil prices are going to be contained. Will there still be a business cycle in there? Are there opportunities to invest in oil and the oil majors, or do you think, given your outlook, there's just so much of this stuff and the potential for so much more of it to come that it's going to remain depressed?
Look, I mean, the long-term real price of all commodities is lower, which is why we don't buy commodity producers or the commodities themselves. We analogize it to buying the VIX. Do you occasionally see a spike? Sure. Much better to fade that spike than it is to try to time it.
Hmm.
That's just our view. We wouldn't be long uranium. We wouldn't be long uranium miners. We wouldn't be long oil or gas producers, coal or coal producers. You plot all those things in ounces of gold, right? The only thing that beats ounces of gold these days is, high technology. Um, the commodity players are deflationary machines who participate in a price-taking market. It's just not a great market. Are there times where they make windfall profits? Sure. And then the government of Great Britain comes and taxes it at a 78% marginal rate, right? You mentioned NVIDIA. They're allowed to make 85% margins, but refiners making 3% margins are gouging the consumers. It's just
Yeah.
we have it all backwards, but it's fine. That's the political landscape. But we generally wouldn't be inspired to buy any commodity or any commodity producer.
All right. Well, I will say that we've got some people who appear on this channel who have differences, a different outlook. But again, Bloomberg, that's what makes a market, right? Smart people who look at data and trends differently. And you make an extremely compelling case for not just your final statements there, but for everything you've told us about today. So, and just wrapping things up here, for folks that very much enjoyed this discussion and would like to get greater access to you and your work, where should they go?
Yeah, Doomberg.com for everything. And I think I mentioned to you before we started, we have a sister publication we've launched I'd like to plug as well. It's nothing to do with energy, of course, but classicsreadaloud.substack.com is the new publication that the Doomberg team is putting out. It's a passion project of one of Doomberg's co-founders and its editor-in-chief. And as the name implies, it's the mission of Classics Read Aloud is to go find and resuscitate and bring back to life some of the great literature from a century ago or longer. And launched that in September. It's off to a great start, something like 14 hours of audio already recorded. And subscriber growth has been strong. And then the reception's been good. So if you're into great literature, read brilliantly and in sort of the Doomberg brand production quality, head over to classicsreadaloud.substack.com. Or if you just want to read the Doomberg stuff, Doomberg.com as well. Adam, always a pleasure. Much congratulations on your success, and may you continue to enjoy it.
Thank you so much, Doomberg. I really, I can't tell you how much I value not just coming on today, but our partnership and our friendship. So thank you so much for that. A couple quick concluding questions for you before I let you go. First, I just have to ask out of personal interest as somebody who read a lot of the classics and enjoyed them in my youth. Can you just name a title or two that have been read so far to give readers a sense of the titles that you guys are dealing with?
Sure. Let me pull up the latest, and I'll just give you the actual ones. It's the classic stuff that you would expect. Hang on, let me just pull it up real quick.
Right.
And
you're talking sort of like the Wuthering Heights of the world.
These are mostly short stories that are actually a little different. So it's a curated set of short stories that are truly classics that you may not know about, which is why I'm pulling up. So like The Willows from Blackwood, or The Legend of Sleepy Hollow, of course.
Sure.
And Shadows on the Wall, The Turn of the Screw was a big one. And so this really great short stories. Novels are kind of hard, as we're finding out. A lot of work goes into reading
they
of a
take
novel.
A long time. You have a lot more than 14 hours. Yeah.
Yeah. So like Alice's Adventures in Wonderland, was put out in mid-September in 7 chapters. But Big Two-Hearted River was the one we launched, Hemingway, where we launched that through a Doomberg piece just to bring it to the attention of our audience. And so that's the kind of work that's been put up. Just go give it a try. I think you'll love it. It's really, really well produced. Great reading voice, great audio editing. It's tight, and there's an essay and an etc. at the end of it, and it's sort of produced in the Doomberg style. Just a wildly different topic. We like to say it shows the breadth and depth of the Doomberg team.
Yeah, as your team uses both hemispheres of the brain there. It is a team of very powerful brains, and I know from firsthand from having spent time with you guys in the real world. But no, that's fantastic, and it really warms my heart. Like I said, as somebody who grew up reading a lot of that material and read precious little of it right now, sadly, and not just our world with all the digital content, but
sure.
just being a content producer like you, we're so busy just doing what we do. But when I get a chance to do that on a rare time, I got a weekend off or a vacation, or whatever. I'm just so glad you guys are keeping those candles lit in the world of the great authors.
Well, look, the motto is you're never too young or too old to enjoy being read to. And so if you're having a road trip and you want to kill some time, grab one of those short stories and see what you think.
All right. Well, Doomberg, when I edit this, I will put up the links both to Doomberg.com and to Classics Read Aloud, so folks know exactly where to go. Folks, the links will be in the description below this video as well. Just quickly in wrapping up, please show your appreciation for Doomberg sharing so much of his intellect and his expertise with us in this discussion by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Doomberg did give us a lot of things to think about in terms of ways in which we may be able to take advantage of some of the investing opportunities from some of these trends. If you would like to get some help from a professional financial advisor in thinking through how which opportunities might be best fits for your own personal portfolio and goals, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. Doomberg, again, can't thank you enough. Let's do this again early in 2026.
You bet.
All right, and in the interim, have a great winter holiday season. And everybody else, thanks so much for watching.
China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000, 9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think, first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yeah.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here, and Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see it in many countries. The society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air, and on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms, they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months, updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You know, you might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about US dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000. And gold came down to 1615 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather a safe haven anchor in that time when everything else was plummeting. So since then, yeah, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative long-term bonds, and now you are in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Yeah. So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. And I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those 4 drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those 4 drivers is that you are seeing now the unwinding of that 50-plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right? Yeah. So we know that in the past 5 decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train. It just pushes higher, and whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, around $9,000, if you remember. Yeah. I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.
That we're still at above 2.5%, close to 3% in the US inflation, consumer price acceleration rate, and the interest rate has been being cut since 2024. You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. The end game is coming. It is coming soon. And this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
U.S. inflation remains near 3% while the Fed continues cutting rates, pushing gold higher alongside rising consumer prices. This policy shift is set to hit the dollar hard, given today's much larger debt levels. Analysts warn that endgame is near, worse for dollar holders than in 1980. But far more rewarding for gold and silver investors, as this time gains are expected to be sustained and even surpassed. Rafi Farber, known as the Endgame Investor, is a financial writer, investor, and precious metals analyst. Recalls that back in 1980, the Fed fought inflation by targeting monetary aggregates, money supply growth rather than just consumer prices. With debt to GDP at only 32%, they could hike rates aggressively, eventually taming inflation and stabilizing the dollar. Today, however, debt to GDP is near record highs at around 120%, leaving no room for similar rate hikes. Instead, the Fed is cutting rates into rising consumer prices and a rising gold market. Unlike 1980, this environment signals a much weaker dollar and far stronger prospects for gold and silver, with gains expected to surpass those of the past. Remember to hit the bell symbol and subscribe as we begin the videos so you don't miss any updates. If you like the video, please leave a comment below and give us a thumbs up.
They wanted the monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart, when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that, once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price. But this is, of course, not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension. And then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate. Inflation, I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate, and you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate, and the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it's going to be the end of it, because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high, where in 1980 they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders, and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
Rafi Farber points out that in 1980 and 81, U.S. inflation and gold prices were surging while the Fed raised interest rates aggressively to regain control. After briefly cutting rates, they were forced to hike again up to nearly 15%, when money supply growth ran hotter than expected. Only once inflation consistently declined did the Fed start cutting rates steadily, which helped stabilize the system and prevented the collapse of the fiat dollar. Now let's review the interview.
And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here, and then back up. Blah, blah, blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up and up, because the U.S. inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising, they were rising and rising and rising, and so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising, And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, but we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the U.S. inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year. This is not really a chart. This is a transcript. I will give you the link in the description below as to exactly where you can find this thing, and it's on page 7 of the PDF that I found it on at the Federal Reserve's website. This is to a staff analysis, says the Federal Reserve Board. The demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money or of the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace.
Unlike 1980, when the Fed had the flexibility to crush inflation with aggressive hikes, today's debt-heavy environment leaves policymakers with fewer tools. Cutting rates into rising inflation risks undermining the dollar while fueling gold and silver to new heights, suggesting this cycle could deliver far more lasting gains for precious metals. Could today's debt levels make it impossible for the Fed to repeat the 1980 playbook? How high might gold and silver climb if the dollar continues to weaken under current policies? Please feel free to leave a remark below with your thoughts. Please give this informative video a thumbs up and subscribe to receive our most recent updates. Thank you for joining us on this trip.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to 2% of it, silver would be $70 or so. But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly, like 3 times. It got up to 3,500 or 3,450. Right now, we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it, and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get a further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro-technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas, like the breaking of the dollar has not been a factor, the dollar index, when you measure it versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015, when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because of financial institutions that are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered two eightfold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action and then it's accelerating. And you say, well, what caused that? And it wasn't because it was declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because they could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.